BrightSpring Health Services, ticker BTSG. Today, we're diving into a classic earnings paradox. You know the setup. A company reports just absolutely pristine, blowout numbers, only to watch its stock take a massive, head-scratching hit.
So what exactly is BrightSpring? Well, think of them as an integrated healthcare machine focused entirely on complex, high-need patients. They take specialized pharmacy services and combine them directly with on-the-ground clinical provider care. Standalone pharmacies, they completely miss out on this clinical touch. And standalone clinics, they lose out on the massive recurring revenue of specialty drugs. But BrightSpring captures both, creating this economic moat that pure-play competitors literally cannot replicate.
When you look under the hood, the bulk of their revenue, a whopping 88%, comes straight from pharmacy solutions. It's the absolute heavyweight of the operation. But listen, don't let that overshadow the provider services wing at 12%. It might seem small by comparison, but you have to understand that this segment is acting as a major, high-margin growth engine for the entire enterprise.
Now, the whole catalyst for this paradox we're talking about is their staggering Q2 earnings beat. Adjusted earnings per share came in at 42 cents. That absolutely crushed Wall Street's consensus expectation of just 18 cents. Generating a 133% beat, that is a massive, undeniable signal of underlying operational strength.
And yet, immediately, after announcing that pristine, fundamental beat and just blowing past expectations, the stock plummeted. It dropped from an all-time high of nearly $74 down to roughly $64 in the immediate aftermath. That's an 11.7% drop on undeniably good news. Welcome to Wall Street, right? Sometimes crushing expectations is the quickest way to trigger a massive sell-off.
So let's unpack exactly what's going on behind the scenes here. First off, this is a classic sell-the-news event driven by pure profit-taking. Keep in mind, this stock had already seen a greater than 200% run-up over the trailing 12 months. Second, you've got significant institutional rebalancing happening. BTSG has a relatively tight retail float, meaning there just aren't that many shares available to the general public. So when a few large institutions decide to take some profits off the table, the price swings wildly. And finally, there were some minor investor jitters over an 8% drop in the home pharmacy subsegment, mostly tied to regulatory changes from the Inflation Reduction Act.
But let's shift gears and look at the underlying fundamentals, because this aggressive double-digit top-line expansion, that's the real story here. In fiscal year 2024, they brought in $8.75 billion. By 2025, that jumped 31% to $11.45 billion. Looking forward, analysts are projecting this revenue to compound at an 18% annual growth rate over the next 5 years. For a long-term investor, that kind of top-line trajectory is exactly what you want anchoring your portfolio.
And the absolutely crucial point here is that they aren't just growing revenue for the sake of it. They are scaling profitably. Adjusted EBITDA margins expanded to 5.3% in Q2 2026, up from 4.5% the year prior. This strong operational leverage is rapidly accelerating their bottom line, and it's allowing management to confidently point toward a raised full-year 2026 guidance, somewhere in the range of $820 to $845 million.
Breaking down those Q2 numbers really exposes the specific engines driving this train. Pharmacy Solutions grew an impressive 22% year-over-year to $3.4 billion, and that was largely fueled by a 31% jump in specialty scripts. Provider Services also put up really strong numbers, growing 30%. But the true standout here, home health revenues surged an incredible 51%. That is explosive growth, heavily supported by their aggressive strategy of rolling out brand new de novo clinical openings. On top of all this, management is flawlessly executing an aggressive post-IPO debt reduction strategy. Coming out of a private equity phase, high debt is almost always a huge red flag for the market. But look at this. Leverage was at 4.16x in 2024. They slashed it to 2.99x in 2025, brought it down to 2.15x by Q2 2026, and now they're firmly targeting a ratio below 2.0 by the end of the year. This rapid deleveraging is creating immense financial flexibility for future acquisitions.
And you can connect that rapidly dropping debt profile directly to their massive cash generation. Management expects operating cash flow for fiscal year 2026 to hit approximately $600 million. This completely proves they've successfully transitioned out of that private equity cash burn phase, evolving into a highly liquid cash-converting machine. They have ample resources to service their debt and organically fund new clinics.
So objectively benchmarking BrightSpring against the broader market reveals a highly compelling valuation. At a 16.4x enterprise value to EBITDA multiple, they sit comfortably right in line with the sector average. But the implications change radically when you factor in their growth metrics. They boast an 18% forward revenue CAGR compared to a sector average of just 7 to 10%. Factor in a projected 5-year net income CAGR of 45%, and the narrative becomes crystal clear. Simply put, premium growth warrants a premium multiple, which makes that 16.4x look highly attractive.
Now, the reason their growth is so explosive in the first place is because they are riding massive, unstoppable secular tailwinds. The entire U.S. healthcare sector is undergoing this permanent structural shift toward value-based, home-centric care. Combine that with a rapidly aging baby boomer population, we're talking roughly 10,000 Americans turning 65 every single day, plus a surge in complex, high-cost specialty drugs, and you literally have a perfect storm of demand. BrightSpring's integrated model is positioned right at the epicenter of these trends, designed specifically to lower systemic healthcare costs while capturing immense enterprise value.
Beyond organic growth, their execution on strategic M&A is just absolutely exceptional. They recently acquired specific, highly targeted branches from Amadeus and LHC, and the integration of those branches is moving much faster than Wall Street expected. The sheer momentum and success of this specific integration is actually one of the primary catalysts that allowed management to confidently raise their full-year guidance.
Of course, no business is without its hurdles. The healthcare industry faces ongoing regulatory pressure, most notably from the Inflation Reduction Act, which has definitely compressed margins on traditional Medicare scripts. But BrightSpring, they're actively restructuring to outmaneuver this. They are voluntarily walking away from uneconomic contracts tied to those IRA changes, and instead pivoting hard toward high-acuity specialty scripts. We're talking rare, orphan therapies. These are critical, often expensive treatments that carry significantly higher margins and effectively insulate the company from traditional retail pharmacy pressures.
Now, it's vital to acknowledge the institutional overhang risk here. BrightSpring was heavily backed by private equity giant KKR and Walgreens Boots Alliance prior to going public. Because they retain significant influence post-IPO, as the stock price appreciates, there's this constant risk of secondary block sales. Basically, when early backers decide to cash out large positions, it creates downward price pressure on the stock. But for retail investors, this just means being prepared for sudden, temporary dips based on technical selling, rather than panicking about a fundamental flaw in the company's underlying business.
Technically speaking, the long-term trend remains a massive uptrend. After hitting that all-time high of $73.75 in late July, this 11% pullback to the $62.82 level is actually a very healthy, totally necessary cooling-off period. More importantly, it brings the stock down directly into a major foundational support zone between $58 and $60. This gives the asset time to digest that massive 200% trailing run-up before its next leg higher. Breaking down Wall Street's consensus scenarios completely impartially, the base case sits at roughly $80. This assumes they simply maintain their current 15 to 18% revenue growth and steady 5.5% margins. The bull case reaches for $94.50, but that requires margins to expand to 6.5% alongside specialty pharmacy continuing to grow at over 30%. On the downside, the bear case of $58.58 maps out exactly what happens if IRA regulatory changes compress margins further and their home health integrations start to stall out. So, synthesizing the fundamentals and the technicals, the actionable strategy here frames this recent drop as a clear opportunity. The verdict? It's a buy, specifically accumulating on pullbacks directly in that $58 to $63 entry zone. With medium to long-term targets sitting between $80 and $95, utilizing a dollar-cost averaging tactic over the next few weeks allows you to aggressively leverage this post-earnings volatility. And, to protect against broader market shocks, utilizing a hard mental stop-loss directly below $54 provides absolute, ironclad risk management.
As we wrap up this detailed analysis, there is a provocative thought I want to leave you with. With the underlying fundamentals looking pristine, and as the entire macro environment shifts permanently toward value-based home care, how much of a premium will the market ultimately pay for a company that has successfully bridged the complex gap between dispensing specialty drugs and providing on-the-ground in-home clinical care? It's a question that will undoubtedly define BrightSpring's trajectory for years to come.